If I ask 10 different people what the word diversification actually means in the context of an investment portfolio, I'd probably get 10 completely different answers. And none of them would be technically wrong, because for some people diversification means just owning the S&P 500 and calling it a day. For others it means adding international stocks so you're not betting everything on one country. For others, it means sprinkling in things like crypto, gold, or real estate assets because you don't trust the traditional system to hold it forever. And then there are people who kind of live in the middle of all those, trying to balance growth, safety, and their own personal comfort with risk. And that's why when most people hear the word diversification, it sounds like one of those boring, vague finance terms that feels important, but it's abstract in a way, like something you're supposed to be doing, but nobody really explains how that connects to your real life. Because diversification isn't just about building the most complicated portfolio you can possibly do or owning a little bit of everything just for the sake of it. Diversification is about building a portfolio that can actually survive the emotional and financial ups and downs of investing. The years where everything feels easy and the years where everything feels like nothing is working and the headlines are screaming at you that the world is falling apart. What I've learned over my time of investing is that diversification isn't just some rigid formula that everyone has to follow exactly the same way. Diversification is personal, and that's why I always like to say the term personal finance is personal because your life will change. Your level of diversification changes too, because a perfect portfolio on paper that keeps you up at night might not actually be perfect for you or your family at that specific moment in time. A diversified portfolio that you can hold through stress, boredom, and uncertainty is far more powerful than the one that looks impressive on paper but falls apart emotionally the first time things go south for you. So, in this video, I'm going to walk you through what diversification means to me and how I'm personally thinking about building my portfolio in 2026. Not because I think my approach is the perfect way or only right way to do it, but because sometimes it's helpful to see a real framework instead of just abstract advice. And you can take what fits in my portfolio and apply it to your situation if that works for you, or leave out anything that you don't want to do. And just to be clear on that, again, this is not financial advice. This is simply me just sharing how I'm thinking about diversification right now, so you can just use this as a reference point. Let me know down in the comments if you have a different diversification strategy than me, because I'd love to hear it and learn what other people are doing this year. So let's get into it. For me, the S&P 500 is kind of my backbone of my investment portfolio diversification, not because I think it's just the perfect investment or immune to downturns, but because the S&P 500 represents a broad slice of the biggest and most influential companies in the US economy. And when I invest in the S&P 500, and for me that's the ETF VOO, I'm not betting on one CEO, one company, or one trend to carry me through the future. I'm betting on the idea that over long periods of time, the overall US economy will continue to innovate, continue to move forward, even through recessions and crises. And I like that this gives me exposure to hundreds of businesses across different industries without me having to pretend I'm smart enough to pick the individual stock winners. The beauty of the S&P 500 is that it's market cap weighted, so that means you may have heavy tech exposure, let's say right now or in the last 5 years, because those are just the best performing companies and they have the most market cap right now in the US economy. If for some reason tech just falls off a cliff, then maybe companies like Walmart or Costco overtake the highest percentage of the S&P 500. And the best part about this is that it's a passive ETF, meaning you don't have to make guesses. The best and top performing 500 companies in the US will always be a part of this ETF, and this ETF has historically returned about a 10% return per year. And if you wanted even more US stock market diversification, you can invest in something like VTI, which tracks the entire US stock market, not just the top 500 companies. So you can see here how there's different levels, different tiers of diversification, even within arguably the most diversified sector of ETFs. There's tiers to it. So again, just invest in what you are comfortable investing in and something you'll stick to long term. Now, personally, I like to choose between either VOO or VTI. I don't like holding both because there's just too much ETF overlap between those two. So for me personally, I choose VOO. Alongside investing in the S&P 500 and getting the broad US market exposure, I also like diversifying across different styles of ETF investing, which is where SCHD and SCHG come in for me because those are two ETFs that represent two very different US market sectors that have their purposes in my investment strategy. SCHD leans more towards dividend paying, income focused companies that tend to be more mature and stable, while SCHD leans more towards growth oriented companies that are reinvesting aggressively and aiming to compound at much higher rates over time. And I like having both of these because it means my portfolio isn't just dependent on one or the other, or dependent on what market environment is doing well at that time. There's some years where SCHD will do well, and there's some years where SCHG would do well. But by adding these two ETFs alongside my VU position, I don't have to guess which sector is going to win ahead of time. I'm committed to this 3 ETF strategy over a long period of time, and that makes sense to me. It's something I'm going to be able to stick to, and it has proved well for me over my last 4 or 5 years of investing. Now, when it comes to Bitcoin, I think of it less as a core pillar of my portfolio and more as a satellite position. This is a very small position in my overall net worth, with Bitcoin being an intentional hedge against the future where the US dollar maybe isn't a top of the world currency anymore. I don't have a doomer mindset, but I'm not oblivious to how governments have historically devalued currency, and I've seen firsthand how much the government has been printing money recently. So it's just a small and calculated bet that Bitcoin will continue to do well in the long run, and I'm not going to do speculative or short term trades with this. I'm going to dollar cost average a very small portion of my portfolio over a long period of time, and I just want to capitalize off gains that Bitcoin could have for the long run. Because Bitcoin is a more volatile, more emotional type of investment, I just again keep it as a small portion of my portfolio because then I'll get the exposure to the upside without letting the wild swings dictate my overall net worth. Diversification for me isn't just about where my investments sit too. It's about where my income comes from because relying on one paycheck, no matter how stable it feels, always carries more risk than we like to admit it. And that's why I think of side income streams like Rover and eventually this YouTube channel as a form of diversification too, since they create additional avenues to make money that aren't directly tied to my main job or the stock market. And even if they start small, the long term goal here is to build additional opportunity to make money, which gives me more breathing room financially and mentally. I would highly recommend everyone try to do at least one side hustle while you still have time in your 20s or your 30s. There are also areas where I'm not diversified yet, but I'm open to adding in the future as my situation changes, such as buying my first house. Buying a house is a great way to diversify because you're owning a physical asset every time you pay down your mortgage, and houses are an appreciating asset. My girlfriend and I are not in a position to buy a house right now, but eventually we want one. I made a whole separate video about this, so I won't bore you with the details here. And then also later in my life, I want to accumulate small amounts of precious metals like gold and silver, but I'm not going to prioritize doing that right now because I see precious metals as more of a wealth preservation rather than wealth accumulation, which is why owning precious metals is just not a priority at this stage of life for me. And I'm focused on investing and letting my investments compound. And my hedge against the US dollar right now is Bitcoin to me. But I don't want to bet too much against the US economy because I believe in it long term. And if I have too much Bitcoin or too much gold, then I'm losing out on that compounding potential of just investing in the US economy. Then there's international stocks, which I don't currently allocate anything really towards at this point because, like I just stated above, I'm personally just a strong believer in the US economy. Despite its flaws and cycles, I think it remains one of the most resilient and innovative economic engines in the world. And if the economic landscape for some reason changes over time, then I'll diversify with it. Then yeah, I might shift some of my assets to international stocks, but for now, I'm sticking with my game plan that I've laid out in this video. So when you zoom out and look at diversification this way, it stops being this rigid textbook definition and textbook concept, and instead it starts feeling more like something that you adapt with over time. The version of diversification that makes sense for you in your early 20s or 30s might look very different than the version of diversification that you'll have when you're 50 or 60. At the end of the day, diversification isn't about trying to perfectly predict the future or building the most complicated investment portfolio ever. It's about giving yourself the best chance to stay consistent through uncertain times, building resilience to your finances so that one bad year doesn't derail your entire plan. And if you can build a portfolio and a set of income streams that you actually believe in and you understand, you're going to be ahead of so many people. And that's basically all I wanted to cover in this video, just the basics on how I'm diversifying for this year and what it really means to me. So leave a comment down below about how you're diversifying your investments. And if you have anything different than me, I'd love to hear it. Give this video a like if you stayed all the way to the end, and subscribe for more personal finance content. I'll see you all in the next one.